Welcome back to another stock market open live stream. Today we have, let's see here, more Houthi attacks outside of Yemen in the good old Strait. We've got a lot of oil traffic through. About 8% of the world's oil traffic goes through the one particular strait known as the Bab al-Mandab shipping lane. This is really retaliatory against Israel. A lot of shipping goes through here, and it's almost daily now that we get updates that there are more drone attacks here. The United States is in the region to also shoot down some Houthi drones. The market so far doesn't seem to be reacting heavily to any kind of these escalations, and the United States being in the region is a way. A lot of folks are believing that there might be a limit to how much the Houthi group, recognized as terrorists, can really pull off against disrupting supply chains. So that's obviously always the big fear, is that supply chains will be disrupted and therefore inflation will go up. When inflation goes up, then obviously the Fed will have to hike again. And if the Fed has to hike again, then the stock market has to unwind all of its cuts. And that makes people sad. So that's obviously potential. Let's see here. NASDAQ, just saw this here. NASDAQ ending, what do we have here? Hold on. NASDAQ it just kicked. Oh, yeah. Okay. Well, we already knew that from, I don't know why they're just now updating that. The NASDAQ 100, we already knew dropped Zoom last week, but they also dropped Enphase. This is the QQQ, right? We're not sure how much of a big deal that's going to be. Let me see what day that actually ends up taking place. That would be interesting. We covered that, but let me get that exact date. Okay, anyway, so while I pull that, let's take a peek at what we've got with bonds here, and then let's get that NASDAQ 100 bit. Do we have it? Of course, they don't make it convenient in this article. Losers! Dang it. Oh, well. Anyway, so pre-market, Dow, S&P, NASDAQ up in green. The 10 years down about 1.5 basis points, and oil's up a little bit again. We're sitting at 78 on Brent, and then on WTI, we're sitting at about 72.85. If we look at the last really year, we're still at the low within the 2023 era. But we are we've had the last few days of a little bit of pop up here in oil prices, thanks to some of that Houthi tension off of the coast of Yemen. BP just announces that it's stopping its voyages through over to shipments basically through the Red Sea. This is following an escalation in attacks and their belief of a deterioration of security in the region. You know, the more this happens, by the way, the more you often get the U.S. that says, "Oh, can you keep shipping, and we'll escort you if we need to." Yeah, you're gonna get stuff like that. So we'll see. Okay, then so that's BP. Then, but again, oil prices even after that news barely moved. So I don't know that there's enough shipping going through this particular strait to have anything more than sort of just a marginal effect on oil prices, especially during the time of really the global macro slowdown everybody's witnessing. There's maybe a little too little damage that can be done to offset the disinflationary effects of a weaker economy. Over the weekend on HouseHack, I posted some catalysts, and one that I particularly am paying attention to is the catalyst. You can actually just go to ehack.com and then you just type in catalyst and you'll get them right here. One that I'm particularly paying attention to is the multivariate core. So the way this works is they update multivariate core after PCE data comes out. PCE data is coming out this Thursday, and they usually update multivariate core the following Monday, but it's going to be the holidays then, so we might not actually get this update until a few days afterwards. But before the end of the year, we should be getting an update on the multivariate core, which I think is so great for exploring the actual chart. I mean, we can do it together here. Just type in multivariate It's a fancy word, multivariate core. And it's always the first link that pops up, New York Fed, and then go over to MCT inflation, decomp. And when you're here, you can play with this chart. And it's really great for the disinflationary deniers to kind of see that even services X housing is trending down. And it's bumpy, right? Don't get me wrong. I mean, we've had bumps up multiple times. We have bumps up over as recently as December of 22, as recently as our last month here, the September to October data. But the trend is pretty evident here. And then, of course, that's services X housing, include housing. Housing's barely even moved down yet. Housing is really the one that we've been saying for a year. Eventually, at some point here, is going to actually pull core inflation down thanks to rents flattening or turning negative in some areas. And so we look back here, we could actually see a nice little trend band. Let's go pull the multivariate trend band. There we go. Look at that. So volatile, but clearly moving in the right direction, which is great. So I like watching this. It's just a nice way to sort of consolidate the inflationary data that we're getting. And that's, of course, in addition to what we're seeing with company disinflation. Reading earnings calls on a daily basis and seeing it is a pretty big deal as well. Let's listen in here. We've got Nick T here suggesting homebuyers kneeling over from sticker shock might think it's crazy that housing could deliver significant relief on inflation. That's the base case for 2024. This is basically a way of arguing what I just said, which is, hey, as home prices come down, we might actually see shelter stop propping up inflation and actually become a negative weight towards inflation. Should be great. Can't come soon enough. All right. So Adobe, by the way, calling off that Figma merger should do well for the stock. The stock market fell after the merger was announced, or rather Adobe fell after the merger was announced. I could see the stock's only up about 2% after it was denied. The acquisition of U.S. Steel by the Japanese Nippon company is kind of unfortunate for that representative. I kind of reply tweeted to them, but there's this representative, Tommy Tuberville, who shorted a bunch of U.S. companies. And he shorted them with put options expiring June 6th. I mean, this stock's now up 28%. It's going to be problematic. But I don't actually think he's shorting to make money. I think he's shorting because he's using it as like a messaging tool to like attract the finance community or something to pay attention to him. But look at some of the stuff he's been shorting. So these shorts expire, I believe a lot of these expire June 4th, or plus or minus. Yeah, it looks like June, September, October 2024. So various expirations here. And these are all bets against Bristol Myers, Applied Materials, Microchip Tech, Occidental Petroleum, Cleveland Cliffs, Microsoft, U.S. Steel. Interesting. Not exactly sure what his anti-American tilt here is. Oh, let's listen in here.
Voting on that meeting, and
this is one of the new Fed guys.
We put out, as we do each quarter, a statement of economic projections, which each of the individual members says what do they anticipate the conditions will be over the coming year and beyond. So the policy change was no change. We kept the rates where they were. I think we reflected, and in my mind, I see that the data on inflation, which I've highlighted on this program with you, Steve, over and over again, is the key thing where we've missed on our mandate, and the key thing that should drive our decision-making is on inflation. And we've seen significant improvement on the inflation front, bringing us back closer to what looks like to our target. And I think that that's reflected in the SEP dots, if you want to think of it that way.
When you put the word any into the statement to talk about additional policy firming or tightening. What is that telling you? Is that telling you that all of a sudden there is no longer a bias to hike, or is there still this bias to hike for the committee?
Well, like I say, I don't speak for anybody on the committee. For me, I believe that if we get improvement on inflation, that we're clearly moving to target, and we're still not there yet. We still need to see these markers. But if we get inflation back into the range of our dual mandate goals, then we've got more symmetric concerns, let's call it, about both sides of the dual mandate.
The reason I'm asking this question, Austin, about what happened last week is because I want to ask you the question about what the market heard. And you guys, it looks like on average, on a median forecast, 3 rate cuts. Somehow the market heard 5 or 6. You said, I don't know when this is going to happen. The market said for sure in March. How do you react to how the market reacted to what you all did last week?
Well, look, I like your phrase, but it's not what you say or what the chair says. It's what do they hear and what do they want to hear. Right. I was confused a bit with was the market just imputing, here's what we want them to be saying? I thought there seemed to be some confusion about how the FOMC even works. We don't debate specific policies speculatively about the future. We vote on that meeting, and we voted at that meeting not to raise rates. We put out an SEP that forecast over next year that the individuals on the FOMC collectively thought conditions are going to not be a recession and inflation is going to be coming down, which would allow us to reduce the restrictiveness. And it's far be it from me to get into the head of what the market is. Right. I think we'd be best to remember the old Volcker lesson that our job is to act and their job is to react. And if we get into one of these circular, well, let's choose our action based on how we think they're going to react to us saying what they would, I think we're going to get mixed up.
I know Becky has a question, but I just want to ask you, did the market go too far? Just a plain, simple question. Is it too aggressive in your mind for what it's pricing in, both how quickly it comes and how much comes?
I don't know. What I will say is the market expectation of the number of rate cuts is greater than what the SEP projection is. So whether that's priced in or not priced in, that is a difference.
Austin, Mr. President, let me take one more kind of crack at the same thing coming back through. We had John Williams, the New York Federal Reserve president, our bank president, on Friday. And the write-ups from what he has said on Squawk Box Friday, what you had said over the weekend, people put it together and made it sound like you guys are kind of talking back what Jay Powell, or what the market interpreted from Jay Powell. Is that a fair assumption? Were you surprised by the market's reaction, and maybe you're trying to get and clarify the message a little bit to the markets?
Well, I wasn't, as I say, I'm not attempting to speak for anybody else, for the chair, for John Williams. Both of them I respect a great deal.
I don't think there's some coordinated effort.
Surprised.
Were you surprised by the market?
What I was surprised that the market reacted and tried to portray that there was some contradiction between what President Williams and Chair Powell had said. In both cases, Chair Powell clarified that people were not talking, we were not debating or voting on future rate increases at that meeting. And John Williams was saying the same thing, that's just how the FOMC works. We debate the policy of that day, we gather more data, and when we come to March or we come to January or we come to whatever the months are, we do not want to pre-commit, in my opinion. Pre-committing what we're going to do at future meetings makes no sense in a transitionary environment like this where we're getting new data, and what happens in that data is what's going to drive our decision.
Mr. President, we were talking to Noah Blackstein, and he actually brought up the Taylor rule. And I don't know how monetary policy should work. It almost reminds me of the science of medicine, and I use the term science loosely. It's an art. sometimes, and I think that's what you do. Some people would like rules-based, but I was trying to figure out whether if purely a drop in inflation would cause the Fed to cut rates, even if the economy was still much stronger than most people had anticipated. Because for some reason, I always think that maybe you're looking for, we hear the Fed wants unemployment to go up before it can relax. And if the jobs numbers hold up like they have, and if the consumer is stronger than people think, but inflation does come down, is that if the PCE is out of whack with where short-term rates are, is that enough reason to get 3 cuts, or do you need to see coincident weakness in the economy to follow through on that?
That's an important subject matter. I think it depends on whether you think something's happening on the supply side simultaneously. So the Taylor rule is based on looking back at the past. In the past, we've only ever gotten inflation down significantly, coupled with big recessions. I've been saying that there's a possibility of this golden path, that we could get the inflation down without a big recession. And for 2023, we're going to at least have made a lot of progress on that front. So you can't answer that question just speculatively / hypothetically. If we kept getting improvements on the supply side and we kept getting the increase in labor force participation that we've seen over the last 6 or 8 months, then you could definitely still be getting strong jobs numbers, strong growth numbers, productivity growth of the type we saw as well. If you were getting those things, you wouldn't have to have the economy tanking to be confident that inflation was coming down.
Hey, Austin, what is the danger here? Well, I was just looking back at a chart of 1974. Inflation started to come down. The Fed cut rates. That went on for a little bit, and then all of a sudden inflation came back. How much concern do you have that you're kind of going into a bad monetary policy historical rhyme here?
So different.
Well, some concern, but I think that 1974, that same thing happened at the end of the Volcker episode. They began cutting. Then they got nervous about inflation. They raised a little bit. There's no problem with that. As long as we're being data dependent, if we're getting external shocks that drive inflation back up or that make us feel like the economy's overheating, I would be prepared to take that into account and keep adjusting the policy. So our job as central bankers is to be paranoid about everything, to be on the lookout for what could go wrong. And I will just always emphasize, easier soft landings than this have been derailed by external shocks. So we shouldn't pretend like, all the external shocks are gone.
Austin, I know that you don't want to speak for the committee, but I also know you're a thoughtful guy. It struck me that you guys have had 2 different phases here where the communication to the market was clear. In the pandemic, the communication was, we're at 0, we're not moving from 0, we're going to be at 0. Inflation came along, communication was clear. You had to be raising rates and raising them strongly, and there was nothing going to get in your way of raising rates. Is it fair to say that the communication around the soft landing is a little tougher? It's not quite as clear, and that you guys are going to have to figure out a different way to communicate with what is really a nuanced message from the Fed in a way that you haven't had to nuance in the past, say, 3 years?
I haven't thought of it that way, but I see what you're saying about there's a certain subtlety to we're going to be data dependent, because then the market wants certainty and they're like, okay, well, then we want to give you 6 hypotheticals. What if the unemployment rate goes to this, the inflation rate goes to that, then what will you do? And we're just, in my view, it's a bad idea to start playing that hypothetical game, because a lot of stuff happens, as in Joe's words, there's a lot of art to that rather than just rule-based. It's not, ChatGPT is not going to replace the FOMC that quickly, because we got to take the whole picture into account, and there is a certain subtlety to that. So I think that's a tougher.
That quickly.
All right, Austin, thanks for joining us, and I hope we'll see you again soon.
Great to see you again.
Yeah, this guy was a little annoying, honestly. It seems like he was just like frustrated. It kind of came across as like, wow, you know, anything could happen, anything could go wrong. It's like, chill, man. Like some things I wrote down, I threw some of them on eHack. You could see them, but we could expand on it a little bit here as well. Remember eHack.com, especially during the week. Check it regularly. You know, updates always coming in there. But you know, he pulled out the Volcker era comment. Our job is to react. The market's job, or our job is to act. The market's job is to react. And I thought that was very interesting. He's pulling out the Volcker era to try to relax the market a little bit. I don't know that the market really cares about this commentary right now, mostly because the market knows what the Fed said in the summary of economic projections. 3 rate cuts next year. The market realizes that. That's not a surprise. And we heard what Jay Powell said. The difference is the summary of economic projections has been wrong at every point in the cycle. So people naturally price this belief in that the Fed will be wrong. That is, they'll have to go higher than they thought they had to go, which was true. And now they'll possibly have to cut more than they thought they had to cut for next year. As even you could see, Goolsby was talking about how important labor productivity and jobs is to sustaining inflation down. Well, that gets ruined pretty quickly if you over tighten, because then you stop seeing hiring. And so that's a really big risk that I think Jerome Powell is much more acutely aware of now, or at least paying attention to now than he was paying attention to previously. So, all right, let's take a look at. Oh yeah, this is an interesting chart. So here's a chart on cash that people believe will be basically a source of funding for the stock market. Excuse me. I believe that as well. Excuse me. All right. I want to show you this. Let's see. This is an interesting one. Oh, let's get that sync going. But basically, it's while I pull it up, money market funds have seen record inflows this year. It just shows charts of inflows. And this is not just the nominal level of money markets, which are up substantially since before the pandemic, but it's also it shows you how much has flown in just 2023. And in 2023, take a peek here. Look at that. Look at those inflows. That's what, 1.5 trillions there almost. Yeah. This at the same time as of this money, Goldman Sachs says equities have only received about 95 billion. So while money markets over 1.4 trillion, equities only received 95. Oh, that's weird. There we go. 95 billion in 2023. And that's what's interesting is that's with the NASDAQ, or we'll call it QQQ SPY at all-time highs. That's wild. That somewhat implies less selling pressure, right? Because when you have less buying, creating more market movements, you're getting to where you have less selling pressure. Let's write that down. Implies less selling pressure. Interesting. Okay. So, let's see here. What are they yapping about here?
It's anything but reasonable. It's a proposal that would, at the end of the day, pretty much, as Commissioner Peirce said when she dissented on the proposal, prescribe certain technologies that the government doesn't like. And AI can and should be a revolution in the provision of financial services to the retail investor. It can make things more efficient, cheaper. And from our perspective at Robinhood, technology is what obviously is in our DNA. It's what's gotten us 23 million customers. It's what allows us to provide commission-free services to customers. So for the government to come in and say, geez, technology is this big, awful thing, and can hurt investors without even doing the research to determine what the uses of AI have been, to come in and say we're going to prescribe these technologies.
Somebody's asking what color the tie is. I was wondering too. I kind of define it as puke green.
If the rule was rewritten to do exactly what Gary Gensler just said, which is to say that the algorithm can never put anybody's interest ahead of the investor's interest, whether that be the financial advisor, whether that be the company pitching things, would that be acceptable to you?
I mean, the rule needs to be rewritten if there is to be a rule. I think, quite frankly,
if it were rewritten simply saying that, would that be acceptable? I mean,
Well,
just the idea that the investor's interest should come first seems like it's not all that cringeworthy.
Yeah, well,
Yeah.
that's the actual prevailing regulatory scheme right now, Becky. So you don't even need a rule.
So
because-
algorithms can't be written to say that say anything like the algorithm has to say that the investor's interest has to come first.
Well, the algorithms are subject to the existing rule set, Regulation BI, the fiduciary duty, the
That's best interest. This is so boring. Like, this guy's just like, I think he got like a mission of like, go on CNBC and rant about the SEC because it's popular to rant out about the SEC with retail. I almost guarantee you that's how that discussion went. It's like, hey, if you go rant about the SEC on CNBC, people want to come invest in Robinhood because it's popular and hate the SEC. But I saw what the SEC released on the artificial intelligence rules. I read everything about it. I did not think, I think I'm 100% with Becky on this one. Becky's like, look, all they're saying is we don't want your AI to treat some customers differently than they would other customers, whether those are minorities, whether they have less money, whether they have more money, whatever. It wasn't a big deal. I don't know, making a big deal out of nothing on that one. I'll walk away from that. But I sometimes I think that's just like marketing and finance is everything's got to be a big deal. It's one of the reasons why I made eHack is just so I can put like, you go to eHack.com, you can see bottom line research every single day. Obviously more so during the week than on weekends because, well, there's more going on during the week. But anyway, all right, let's see what data we can get here. I'm trying to load up some, I want to see JPM, US weekly prospects. All right, let's take a look what JPM thinks the prospects are for markets and otherwise this week. So we'll get that up in just a moment. Not sure why that iPad's like asleep today. And in the meantime, we'll take a peek here at how some of the pre-market moves are going. There's US Steel after that acquisition talk, up 28.4%. Sorry, Senator Tuberville, or whatever, who was shorting a bunch of US companies, including US Steel. It's going to suck. Yep, there we go. All right. So on the upside, we also have NEO moving up. We looked at some of the NEO financials just the other day on the Meet Kevin podcast. It's actually not that bad. It's a much more profitable enterprise than Rivian is. The problem is, your question or your expectations on the Chinese economy, which there's some indications might be bottoming out. Maybe Kenny G is right that you're pretty close to a bottom in China. But who really knows? I have no idea. Affirm down 5% here in pre-market. SolarEdge down another 5%. I wonder if there's specific Affirm news that's dragging them down this much. Take a quick peek at Affirm. Affirm cut to underweight by Morgan Stanley following rally. Yeah, but then Truist Securities raised their price target to $55 on Affirm. Yeah, that's no news here. And then S-Edge. Roku also seems like it's been having a little bit of a rough few days after its rally. Let's see here. Yeah, it started trending down at the end of November there. No, nothing specifically on SolarEdge, with the exception of the fact that now there's talk about options volume starting to surge on some of these companies, including $110 call options, $110 call options on SolarEdge. Probably, honestly, have something similar going on with Enphase because they feel like they're finally coming out of their bottom. Once Enphase broke that downtrend, which we've been waiting for, it popped. Unsurprising. Now it's just can it stay above that trend and see where it goes. All right. Ferrelli. Oh, Mike Ferrelli. What have you to say today about the U.S. markets? Let's find out. See, because his last name sounds Italian. I don't know. Probably is. All right. Let's do this. Oh, yep, there we go. Chair Powell and the FOMC open the door to easing next year. We'll look for the first rate cut in June. That's JPM's expectation. Retail sales was decent. Retail sales growth was decent last month and consistent with another good consumption quarter. Manufacturing still looks fairly anemic. Busy week for the economy, especially with Powell. Okay, we already know what Powell said. Let's see here. In some of the main CPI details. Yeah, let's take a look at their CPI details. Let's see here. Food prices there. Okay, with core, there were some surprises. Unexpected firmness in rent measures. That's true. When we actually end up seeing this rollover is the big question. Everybody keeps talking about it, but it's like, where is the housing rollover in the inflationary data? I don't know. It's kind of a good point to bring this up. Supercore rose 0.4% in November. 5.2% seasonally adjusted over the last 3 months. Seasonally adjusted over the last 3 months. I don't know. That might be a little bit of a tough thing to really parse out. We've been expecting. Yeah, I think actually, you know what? Nick T actually has a chart on the 3-month annualized, and the 3-month is much more volatile than the 6 and 12. I think it's worth looking at. Let's see if we can get that 3-month and compare to what JPM's targeting here. So here we go. Close. I know he's got. Here we go. Okay, so this is what JPM's looking at. They're looking at the 3-month. Yeah, okay. This is the 3-month annualized. And theirs isn't 3-month annualized. They're just, actually, it seems like it would have to be. Yeah, anyway, so I don't know how they're getting to the super core. Oh, they're annualizing 3-month super core rather than just core. I see. Yeah, but again, this chart's useful at showing us as well that 3-month is very volatile. Much less volatile are those 6 and 12 months. Okay, that's fair though. Away from rent inflation, we think that weakening in the labor markets could be an important factor to weigh into prices. Oh, totally. I mean, even Goolsby just talked about that. Even though I kind of think that guy's a nut, he's right to say soft landings could be derailed by external shocks or even internal shocks, and one of those could be the jobs market. Consumer spending stayed healthy. Yeah, that was on the retail sales. Auto sector, including manufacturing, still negative. It's also not a surprise. All right, few industries driving employment gains. Ooh, let's take a look. Labor market has continued to add jobs at a solid rate, although the jobs market has become less widespread, a lack of diffusion. Here we examine where the job growth has come from. We run models amongst blah, 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 whatever. And here you go. Coefficient relating to Fed funds rate, relating the Fed funds rate to the changing coefficient. Okay, well, this gets a little complicated. I just want to look at the specific. Here we go. Employment growth by industry. That's what we're looking for. So where do we sit? Well, this right here, education and health, is generally deemed to be pretty late stage, as well as government. The reason, by the way, these tend to be late stage is because it becomes easier for the government, for example, to or teachers to be hired when there are less private market jobs that might end up paying more money. So the availability of jobs at the government or in healthcare, or mostly the government and education, somewhat healthcare, especially since there are obviously a lot of government-run healthcare institutions, government-run hospitals or whatever. These fields become substantially more important towards the tighter economy because A, they could prop up employment, but B, it's easier for them to hire. The question is, what happens when they stop hiring because they filled up? Everything else is basically trying to stay neutral, relatively averaging over here, all these other dots. While there's plenty of noise and variation, at the extreme, we do find that industries that have responded more favorably to higher rates in the past have been large contributors to overall jobs growth lately. In fact, information, education, healthcare, and government sectors have added 143,000 jobs per month on average, while all other industries have generated about 60,000. Yet one of the reasons you get the IT sector doing so well is because the IT sector is driven by companies that have a lot of cash. And these companies with a lot of cash, including companies like Microsoft, they make so much money on interest in higher rate environments that it's kind of hard to be bearish. Higher rates don't hit them that hard. Let's listen in over here at CNBC for a moment.
$5 a share, all cash. It even gets up to an actual number of $14 billion in equity value. That's pretty impressive. We've talked for years about how U.S. Steel was really a tiny little company. Not so much when it sells, and you have to give the board and management their due here. Cleveland Cliffs came. They said, no, thank you. We're not interested in that number. We're going to try to maximize shareholder value, and maximize they did, didn't they?
Well, I've got to tell you, they sure did. And I got to hand it to them because Nippon is number 1 in Japan, number 4 worldwide, but really is not a real player here. So I think that what a banker might have just said is, look, given the fact that our antitrust organizations are both very, very tough, let's find someone who has very little overlap. Well, when I look at the overlap here, David, it's about as low as you can get.
It's a great point, Jim. Domestically, the overlap is very small. We had made the point many times that Cleveland Cliffs, again, steel is a global market, but there could be arguments given tariffs and the like that you do need to look at the domestic makers and what they offer to, for example, the automakers. The combination there of Cleveland Cliffs, for example, and U.S. Steel would at least have raised some real questions. This doesn't do that. By the way, I do have some questions, which is there's no real cost synergies here either.
No.
So they're paying 55 with no cost synergies. They're talking about.
All right, kind of just yapping about steel over here. So let's see what else some of the suits have to say this morning. So the flow of money was very interesting about the cash that's come into the stock market. You know, it's wild to think that, what was it, $94 billion essentially per Goldman Sachs flooded into the stock market in 2023, which is nominal compared to the $1 trillion that flooded into cash and cash equivalents. And when you think about it, in 2024, Elon Musk selling like $24 billion. Elon Musk basically in that case sold as much as about 25% of what people have invested in the entire US stock market this year. Wow. That's a lot. That's a bizarre perspective. And that's a lot, or it's because little has gone into the stock market this year. It wouldn't surprise me if it's a combination of both. Mostly because people have been so fearful about the return of inflation. I don't see it at companies. I see the return of deflation. But what are you going to do? Well, I'm going to keep reading. That's what we're going to do. Ooh, it looks like Rabobank has a piece on the Red Sea. I want to take a look at this. So let's look at this together. We'll look at the Red Sea piece here. Pretty sure, given that their title is Hearing Things and Seeing Red with SEA, that must be what they're talking about. Somebody says SunPower is down 30%. Really? SunPower is like I don't think they actually manufacture anything. They're like those people that knock on your doors and try to sell you solar scambles. You know, I did a popular piece on that years ago, back in like 2019, and I'm so tired of these companies coming in and trying to sell people these 20-year leases. All right, what do we got here? So there's some issues here. Hold on. So SunPower received a notice of deficiency, which means they could get delisted. SunPower. And it also looks like there's some kind of event default that could result in an acceleration of their debt. I wonder what that is. There's an Atlas credit agreement. And really, if you accelerate your debt repayment, you limit the cash the company has. So the company potentially has to go to the stock market to raise money. Interesting. That could be what's going on. SunPower. Let's take a look at their stock quickly. Oh, yeah. So, yeah, it's down 26%, down to $4.5. Puts you right about where it was. Well, a little bit above where it was in the lows. Yikes. Yeah, that one's not one of my favorites. It's not a company I would have touched from the beginning. But in the short term, yeah, it seems like there's some kind of debt problem going on here. The downsides of debt. All right, let's see what we got here on Seeing Red. The Nasdaq closed at a record high on Friday. This came after the 10-year fell to 3.91. Brent crude remained mostly unchanged after sharp gains on Thursday. Markets have been in jubilation mode since the Fed discussed their pivot last week. Let's see. This demonstrates that beauty is in the eye of the beholder. They're talking about the idea of the Fed rate cuts, kind of complaining about that. They don't really care about Rabobank's opinion right now about that. Let's go to, where's the Red Sea talk? Here we go. The economy focuses on the potential of further shocks from conflicts in the Middle East. Australia is reportedly in talks with the Pentagon about a U.S. request to send an Australian warship to the Red Sea to assist in dealing with the Houthis, who've been disrupting commercial shipping in the region. This request comes just days after Congress passed a law enabling the sale of Virginia-class submarines to Australia. The agreement marks just the second time that the U.S. has shared nuclear secrets with another country, on purpose at least. Right. This is, I wonder if this is an implication about providing like, nuclear weapon secrets to folks in the Middle East in like the 70s, which basically built the thesis that, well, they have the nuclear plans, and built the thesis that there were nukes in the Middle East for 2001. So this is not without this is not without complications. Let's see. Strategic autonomy. Okay, Red Sea. I want to see more of this. All right, here we go. 150 years of supply chain improvement risks being unwound as major shipping companies redirect vessels around the Cape of Good Hope to avoid traversing the region to pass through the Suez Canal into the Mediterranean. This could have major implications for the durability of goods disinflation, or quite frankly, deflation, that we've recently witnessed. I don't really see the damages that large, especially while you have the U.S. military providing at least some support in the region there. What happens with good inflation if the United States becomes more selective and its policing of shipping lanes? Right. Well, that's a fair prospect. It's like, well, what if the U.S. isn't there to continue controlling, or at least trying to control the shipping lanes? All right. Well, I mean, that's fair speculation. If they're basically making the argument that, like, yeah, this could be a problem if the U.S. just stops policing it, right? But they are, so then that becomes more speculative again. Oh, that was silly. Rabobank, that was disappointing. I was looking for some real news. You didn't give me anything. In Israel now, it looks like 19,435 people have been killed, 52,286 have been injured since the attacks began on October 7th. It's a lot. It's terrible. A lot of children, too. It's disgusting. All right. So we're about 20 minutes away from the opening bell. and listen in for a moment, see if they've got anything interesting here. Lumina? That doesn't sound
The only
interesting.
thing that I thought would make them more competitive was Grail. Why? Because Grail is the one drop of blood.
Yeah, more drug talk. That's what we want, right? No. Do I agree that the U.S. risk-free rate is 0%? No. I mean, right now, the risk-free rate is whatever treasuries are. It's probably like 4 or 5%, which is wild, right? Let's listen into Bloomberg. See if they get anything better.
One standard deviation above the long-term average. This is something you see very early cycle, not end of cycle, and it's the kind of thing that if the Fed does cut aggressively, you could see a rebound in inflation. Given wage growth and all the other parts of the economy, they're still looking pretty hot.
Okay, what happens if Jared's right?
I mean, if inflation were to rebound, which I would say we put as a pretty low probability event in the second half of next year, because we do think we're going to see a steady deceleration in overall economic activity, perhaps not a big recession. I think we're kind of in a glide path here. But if we were to see a rebound in inflation, that certainly would be a big hit for risk appetite. If the Fed had to talk about normalizing policy further, that would be a big risk for the equity market. But I do want to make a point here about one of the risks for the second half of 2024 that we need to talk about, which is 2024 is an election year. And during election years, especially if there's a chance of a significant change in administration and policy, sometimes companies sit back a little bit and don't engage in capital expenditure outside of necessary maintenance CapEx, right? They just sort of say, we'll do what's necessary, but let's see if there's a change in the tax regime or a change in regulation that's going to impact my ability to do business. So sometimes in the kind of the fourth year of a presidential cycle, during a big contested election, you will see a change in spending. So that I'm watching, which may lead to some dampness in the economy. It's not keeping me up at night, but it's something that's definitely a risk.
Okay, sit tight. Just going to stick with us. Kate Moore there alongside Jared Woodard. Right now in equity markets, about 17 minutes away from the opening bell. Futures still positive by 0.25%. With some movers this morning going into the opening bell, let's say good morning to Simone Foxman.
Yeah, good morning, John. M&A driving a lot of our biggest movers this morning. The big one.
I have to say, I sometimes I kind of like Bloomberg here.
Coming from Nippon Steel in Japan. This would equate to about $55 a share in cash. You can see right now U.S. Steel in the pre-market trading relatively close to that. That's about 142% premium to Friday. You may remember this name had been the subject of a bidding war, but those offers were like $32, $35 a share, so much higher. Also an M&A, Adobe and Figma scrapping their $20 billion merger pact after Adobe saying it wouldn't make some changes to win approval from the UK's Competition and Markets Authority. Shares there higher in the pre-market. Also watching Coinbase. The SEC rejected its proposal for new regulations for the digital asset sector. Now the company is going back to the appeals court, asking the SEC to be forced to move forward with new rules. We saw Bitcoin briefly drop below $41,000. It is among Coinbase is among other crypto-tied names that are falling this morning, John.
Simone, thank you. More from Simone around the opening bell. Coming up on this program, pushing back against Pivot Talk.
We made a lot of
there he is. What did he go? Oh, see, dude, this guy drives me nuts. I don't even need to listen to him to feel anxiety. I just need to see him and do the jeez Lord. Oh man. Okay. Oh wow. All right. Jeez. My goodness. So anyway, this is wild, folks. So look at this. We have the Qs right here, and we are still sitting at a all-time high here. How wild is that? All-time high. Now, what I'd like to do is, I think it's reasonable, but we've had about, not since 2019, I go back to 2021, we've got about 19% inflation that we want to throw in to some of these figures here. So personally, I like to think that even if we're matched with the previous all-time high, we're probably still about 19% from actual all-time highs. So, yeah, let's go. If I go just to an inflation adjustment here, what was the high over here? We're like 402.63. That's the averaged high. I think the actual high was about 404. So I'm going to go with 404 times 1.18. An inflation adjusted all-time high on the Qs would be somewhere around 476. Kind of wild. Somebody here says, Kevin, you said you're shorting Costco. Yep, I do have a little bit of a short against Costco. I usually don't short, but I do against Costco. And why? But not via puts since options are high, but also planning on increasing position. No. I never said I was planning on increasing a position in Costco. I said I was planning on increasing my short against Costco. So why would I not sell puts while volatility is high? Because I don't want to own it. Simple. That's the problem when you sell puts, is that if it does end up going down, you you have to buy it. Now it could be a rough time to do that, because if the entire market floats up, then it's obviously harder for shorts to pay off. But it's all right. That was just a small little bet. Costco might raise their membership fees. Yeah, I doubt that. Costco right now, in order to, honestly, if Costco raises their membership fees, I'll probably add some more shorts. What they need is user growth right now. They need membership to grow. So they're cutting prices like crazy on their goods. And, Costco's only like $5 a month. It's actually a really good deal. Their membership's pretty cheap. 5 to 10, depending on if you want the credit card or not. But that's also cheap. So I don't dislike Costco as a company at all. I just think they're way overvalued right now. It's crazy. Part of it, I think, has to do with people waiting for this dividend, which, we've got about a month to get through for that. But yeah, I mean, you're looking at, after that dividend, you're looking ahead at $15 of earnings for a company that's trading for $658. It's trading for 42 times earnings with growth that's sitting at 8%. I mean, it's on a peg basis, it's one of the craziest valuations I've seen. 42 divided by 8, bro, that's like a 5 peg. It's insane. So I think there's some safety playness going on here. I don't know, there's something weird going on here. And if you go to Costco, you will get a discount on the membership. It comes out to $70 or to give or take. Yeah, well, there's one option that's $60, and there's one option that's $120. If you're suggesting you can get it cheaper in the store than online, I didn't know that. That's cool. Oh, and I agree, Costco's better than Sam's. Yeah, I'm not the biggest fan. Well, but then again, I personally, I don't go to them anyway. We just sort of DoorDash, like if we need Costco. I think you pay like a fraction more for their membership, but membership is a bargain. Like if you're a DoorDasher, you should totally have a membership. You make your money back so fast. All right, cool. Let's keep listening here for a moment. Well, we're 11 minutes away from the bell.
Maybe the next payrolls report and CPI, which we still get relatively early in January. You will probably see a little bit of profit taking, I would imagine. You look at some of the survey data on Treasury sentiment, for example, the JP Morgan data came out over the weekend, and that showed that a lot of longs are now more flat in terms of Treasury positioning. So, and I think we'll see a little bit more of that. So, but that being said, I think 4% plus or minus 10 basis points is probably where we'll end the year on 10-year yields.
We've had a big conversation throughout this morning about the difference between cutting interest rates and easing, with a focus on the real rate. From the market's perspective, a question that I've lent on this morning, do you think that's a distinction without a difference for financial markets?
Well, I think there is a little bit of question in that, because when you listen to Chris Waller, and what he mentioned was, well, look, if inflation's coming down, we're getting more restrictive, right? So that idea that the real Fed funds rate is actually going up as inflation comes down, and the market, I think, has kind of leaned into that a little bit, and certainly what Jay Powell said kind of had some confirmation bias to that. But that being said, you look at what real rates have done in the market, and TIPS real yields now at 1.75% on 10-year tips. That means that the market at least thinks that there's going to be much easier monetary policy going forward as opposed to when we were 75 basis points higher in terms of real yields. So yeah, I do think that the market is, you know, leading into these individual statements.
I want to touch quickly on NEO. NEO, by the way, quick note here, $2.2 billion cash infusion from an investment group backed by the Abu Dhabi government. CYVN Holdings is buying new shares to take its stake above 20%. So basically a big buy the dip there on, and those must be new. Oh yeah, these are on new shares. So basically NEO created new shares, but they didn't, even though that dilutes existing investors, they didn't ask existing investors to buy those shares. They had a deal with somebody else already to buy the shares. That's really interesting.
And like we have to wait and see is also worth paying attention to. I mean, I think the message for markets is like, don't get ahead of yourself in expecting a huge number of rate cuts in the first half of 2024. We still think growth is going to look quite good. Some of the disinflationary pressures or the speed of disinflation may ease a little bit in the first part of 2024, but that doesn't mean, and I'm going to make another pitch for this, that it's like game over for equities. I still think there's a risk on move to be had, John, going into 2024.
Are there some basic underlying assumptions you're making on the bond market, though, Kate, to make that call?
Yeah, that's right. I mean, to Ira's point, I would expect stability in yields. If we had a huge amount of bond volatility, if we ended up seeing, let's say, a sustainable rise above 4.10, and there was upward pressure, I mean, that would be a little bit tougher case for equities. But I do think we're going to be able to move past the obsession with monetary policy, the obsession with Fed speak, and focus a little bit more on fundamentals, which I think are going to improve. And by fundamentals, I mean specifically earnings next year.
Okay, I hope that is not just a dream. That is actually a call. And it might actually materialize. You know, I think we're all on the same page. We all want to stop talking about this. Kate, thank you. Always fantastic to catch up with the brilliant Kate Moore of BlackRock alongside Jared Woodard of Bank of America. Going into the opening bell, about 7 minutes away. Equity futures still positive here by 0.2% despite all of that pushback from Fed officials. Coming up next, the morning calls, and later, State Street's Laurie Heinel on why uncertainty is bound to persist in 2024. More still ahead from New York City. Good morning.
Let's take a quick look at the NEO financials after that NEO update here. Not too much there to comment on what was just said with Bloomberg. I think pretty straightforward. But let's look at the NEO investor relations page. So we'll do this quickly. We've got the bell in about 6 minutes, but honestly, I should have a pretty good memory of what I talked about the last time, so I think I can fly through this pretty quickly. Oh boy. The reports of foreign issuers are always harder to go through. Yeah, there's the, okay, we'll look at both of these. Here I have unaudited third quarter financial results. I want those. And then I have the investment by this Abu Dhabi backed group. So I have both of these. They come out as 6Ks, these foreign issuer ones. I'm generally not the biggest fan of investing in foreign issuers. But good on NEO here. All right. So financials. Here we go. So look at this. I mean, they have 11% gross margins on their vehicles in Q3. This represents a doubling of margin from the second quarter, roughly, as they're clearly getting back to scale or recovering or whatever it is. But that's actually pretty good. Now they delivered cumulatively, there are almost 500,000 NEOs on the road. They delivered 16,000 vehicles in October, about 16,000 as well in November. We've got, let's look at some more of their actual financials here. Where are their statements? Stand by. Here we go. Yeah, this is where you could see their margin in dollars. So on the right side here, this is where you could see the 11%. Let's draw that right here. This is about where you can see that 11% margin. It's pretty good. I mean, what, Tesla fell to like 16% margin? And I mean, when you think about it, it's like Tesla down at 16%, NIO down at 11%. That's not bad. And then, you know, I saw somebody in the comments here. They're like, oh, Kevin, it's not always about PEG. No, I know that. But it could be a signal for you, which will be relevant here for NIO as well. PEG could be a signal for you in terms of what people's sentiment are. So, for example, if you have a non-growth stock that is relying on growth and membership and has like a ludicrous valuation from a PEG point of view, you start scratching your head going, okay, why? Well, it's because it's seen as a safety play, right? So it's a defensive play. It's seen as a staple or defensive in a potential recessionary time. Well, what happens when everybody actually wants to pay a reasonable price for growth? Well, then they potentially leave those those staples and defensives like Costco, and all of a sudden Costco's valuation comes back into normalcy. So I personally think Costco is 2x what it's worth. And don't get me wrong, I still think it's a great company. Like, I think when people hear, bearish on a stock price that you hate their company and you want them to die. Sometimes I feel like that's what it comes across as in the commentary. You know, you're like, what? You don't like my stock? Are you saying you want me to die? What? Anyway, so this is really interesting when we compare this Tesla NIO item here. The problem with NIO is you're just still facing losses, right? So you can't even really conduct a valuation over here because you're still facing losses. And these losses, about 3 minutes to the bell, by the way, these losses are being driven by their OPEX. Their OPEX sitting at $663 million. They're not basically manufacturing enough cars at 11% to offset their OPEX. Their OPEX, I'm going to write this down. Their OPEX grew too quickly relative to how much they're building. Now, this could be due to catch-up desires, right? I mean, NIO, when was NIO founded? NIO was Next EV in 2014 to 2016. They were founded 9 years ago in 2014. Okay, so 2014, right? Tesla's been around a lot longer. So NIO founded 2014. There we go. Write that down. So, those are interesting little notes to pay attention to. We've got, what do we got here? Mezzanine equity. Okay, fine. Liabilities. Okay, so we've got about $3.3 billion of cash, short-term investments too. So we got about $5.5 billion here available in funds. Debts on the current side, I mean, leases are nominal here. You've got about 7.5 in short-term debts, right? So kind of no surprise that they literally just raised the $2 billion that they needed. Look at that. Literally the $2 billion they needed, they just raised to cover their short-term obligations. Lulz. Oh, I want to switch to CNBC. Well, let's get that bell.
Why penalize something that's doing very well when it's now inexpensive with tremendous growth cap? I like NVIDIA more than all the ones that are being upgraded. All of them.
Right. All right. I picked up my papers here to make sure I know who's ringing the opening bell. It's Bolero.
Yes, and I've had them on a number of times.
I know you have. It's one of those Bowlers Association, by the way, over at the NASDAQ. We Buy Global. It's an e-commerce retailer. Yeah, right. Bolero. You like that company?
Well, they've missed their quarter several times. Okay, and I obviously don't like companies that miss their quarters at the same time.
Well, that looked mostly green. Let's take a look at what's going on over here. Saw comments about Instacart. When Instacart IPO'd, I did a video on them right before their IPO. I was not very bullish on them, and stock has not done very well. That doesn't mean it can't recover and do well. It might be worth analyzing again now that it's fallen so much. NASDAQ here looks like it's kind of uncertain with its direction. See a red candle here, but also see it positive slightly. Got Tesla bobbing around zero, basically. Enphase trying to green candlestick here. U.S. Steel's got its 26% on acquisition, staying pretty stable here. There we go. Q's going positive. You've got Instacart. Cost goes up 78 bips. Instacart's down 7. We've got JP Morgan. You know, it seems like the banks are starting to move again. Look at that. Look at JP Morgan from 137 up to 165 over here. Nice little rally. And this is quite a big rally. I think you just hit all-time highs actually on JPM. Yeah, look at that. All-time highs just hit on JPM. Wow. Good for them. All right, Tesla just dropped it down about 0.25%. Affirm's down 6%. Roku's down 1.5. Enphase down 0.94. And SunPower's down 19. SunPower's actually recovering. Redfin's down another 3%. Matterport down 1.7. Looking at the upside, NEO definitely paired some of its gains here. NVIDIA, 493. 493 for NVIDIA. Etsy up about 1%. NEO's only up 4% now. They were up a little earlier. So it seems like, yeah, they're dropping a little bit here. Looks like some people might be pulling their money out as that market opens there. And then I think I just saw Trade Desk. Yeah, Trade Desk up about 41 basis points next to Bill.com, American Express. Both of these, or all of these actually, ticking up a little bit. 420 on MasterCard. Palantir's up fractionally here. All right, we'll see how things evolve this morning. There's our Q, sitting up about 18 bips right now. All right, so let's finish just looking at NEO here briefly. So how I always like to write little notes here, because otherwise I forget how interesting that right after their shortly after their financials showing a deficit of around $2 billion in cash to short-term liabilities, the company raises $2.1 billion. You know, another thing that I'm noticing is some of these, also noticing a continuation almost of trend. By the way, we like doing analysis like this every day in the course member live stream. So if you're not part of them, make sure you join those. We go through various companies almost every single day, earnings reports, real estate, Q&A, you name it. But I'm noticing this continued trend of Middle Eastern countries increasing exposure to non-Tesla EVs, right? I mean, this is Abu Dhabi backed today, and you know, the Saudis into Lucid, for example. It's almost like, you know, a way to. It's almost like, do those in the Middle East see Tesla as more American than Biden does? Ooh, yikes. Probably. Does Biden know Tesla exists? Anyway. Oh, look at Tesla there. Wow. Holy smokes.
Gained the lead.
It just out of nowhere. It's down like 0.33%. Now it's up 80 bips. Enphase is almost green. Look at that. SunPower's actually trying to recover here. Instacart just went positive. Coinbase went positive. Wow. Apple's down about 1%. Oh, that's interesting. Wonder what would did something just pop on Apple? Let's find out. Apple. Oil prices extend gains. WTI 73.91. Oh, interesting. Oh, the acceleration of the Chinese iPhone ban. Oh, I see. Okay. Let's get them bonds. Capitalism. Full diaper daddy. Oh my God. What kind of name is that? Yes, he gives billions in subsidies to Elon's companies. Well, let's understand that for a moment. Is it Biden? Or is that the broad rule of electric vehicle manufacturers, are eligible for subsidies. Now, Biden did have a supercharger deal specifically with Tesla. I'll give him that. That is true. There was a supercharger deal with Tesla for subsidies for the superchargers. The EV tax credits, though, those apply to the entire industry, and the Treasury Department interprets which car companies are eligible for those. But you're right. That car charger deal was pretty good. What's going on with Amazon? Somebody says Amazon's popping off a little bit. 1.46%. Kevin, will house prices shoot higher with rates going down next year? I'm not convinced by that. That's why I'm pretty picky. I don't like to speculate. I like to buy good deals, and that are inherently good deals, not betting on next year. Mostly because I do think we're going to see inventory rise substantially in the spring, like substantially. And while I do think it'll be offset by a good amount of buyers, I don't know what the balance will be and what the equilibrium will bring. Nobody knows that right now. Everybody's speculating on that. Apple halting some watch sales in the US. Really, I'm not seeing that. That's interesting. Wonder why. Somebody's asking about DWAC. DWAC, $17. It has been 17 for a while, hasn't it? Somebody else saying here, Snapchat. Oh, 9 to 5 Mac is reporting it. Okay. Snapchat. Oh, look at that snap run. That's basically doubled in the last month. So 9 to 5 Mac. Apple to halt Apple Watch Series 9 and Apple Watch Ultra 2 in the US this week. Why? No longer be available to purchase later this week. The move comes following an ITC ruling as part of a long-running patent dispute between Apple and the medical technology company Masimo around Apple's blood oxygen sensor technology. What? Starting Thursday at 3 p.m., in-store inventory will no longer be available after the 24th. Wow. Biden could veto the ruling. Yeah, it's just because of the blood oxygen monitor. Huh. That is weird. Patent dispute. That's unfortunate. What happens next? No timeline for when they might be available again. Again, Biden could still step in and veto the decision. But the those related patents aren't set to expire until 2028. Yeah, that's not great for Apple. That's very interesting. I work with the company Masimo. Ooh. All right. So that might explain this Tesla move. Or sorry, the Apple move. Yeah, look at that. Apple down now 1.18. Yeah, that's a good catch. Oh, thanks, Training Systems, dude. Appreciate you joining as a member. So, okay, GameStop at 5%, Open Door 4%, Etsy, Adobe, a lot of various different stocks here moving. Where's Tesla? Somebody mentioned it got rejected off one line. No, 256. Let's zoom out on this. Oh, yeah, we're at a fib. Yeah, I got it as 258. We'll see. That's my projection for Tesla, by the way, in case you haven't seen it before. It's just a purple line going straight up if you can't tell. Okay. Let's get another piece from the suits here before it's time to go. So, okay, while I pull a piece from the suits, I'm going to play this really quick, and then we're going to look at a piece from the suits. So don't leave just yet. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. All right, check this out. The great disinflation. Let's take a couple minutes and just look at this really quick. Global inflation continues to plummet. I like the sound of that. Hold on, let's see here. Okay, well. Why can't I? What's going on? My files. Inbox. Got it. There you go. It wasn't letting me draw on it for a moment. I want to draw. I'm like a little boy. I just want to color. Global inflation continues to plummet, averaging across the broad group of economies. That's all large and unwanted post-COVID surge. G10, excluding Japan's early hikes. We estimate that core inflation ran an annualized pace of 2.2% over the past 3 months for the G10. We therefore now see earlier and more aggressive rate cuts from several major central banks. Yeah, look at that. This is a G10 excluding Japan. Look at that disinflation. Oh, that's juicy. Some juicy disinflation over here. That's pretty obvious too. Okay, shift in monetary policy expectations has been particularly abrupt in the U.S. Well, yeah, we saw that. Now expect year-on-year PCE inflation to dip below 2.5%. We see the committee as delivering 3 back-to-back 25 BP cuts, possibly March, May, June. An adjustment that would resemble 1995, 98, and 2019. 75 BP in cuts would still leave us at about 4.5%, though. About 200 bips above the long-term estimate. Yep, still pretty aggressive. Our funds rate view is at least as aggressive as market pricing over the next few quarters because the inflation outlook is so supportive, in part because of a further slowdown in rental components, likely to shave off nearly half a percentage point over the next year. Beyond mid-2024, however, the forecast is slightly above market pricing because we have become more optimistic about growth. Wow, Goldman talking about becoming more optimistic about growth and employment. Wow. We now expect real GDP to grow 2% in 2024. This argues for slower cuts. And any further surprises could drive that up. So Goldman Sachs for GDP is far above consensus. Yeah, no kidding. Look at that. Wow. Whatever Bloomberg consensus here they pulled is only at about 0.7%. It's pretty wild. The inflation surprise, and thus the changes to our monetary policy views have been smaller elsewhere. Nevertheless, we've shaved our policy rate forecasts for a range of other central banks. China's below target inflation underscores the need for stimulus. Stimulus. China stimulus checks? See, the difference is they're not doing it. Combination of solid growth, sharpened decline in inflation, and easier monetary policy is exceptionally friendly for risk assets. See, that's why they're raising their price targets for the S&P 500. This explains second S&P price target hike in 4 weeks, up 9% in target. Yup. That's it. Well, that was a fun little piece. Well, folks, I got to go to the course member live stream. Thank you so very much for being here. We'll see you next one.